Q1 earnings are coming in well ahead of expectations. AI capital expenditures is on a path to $1 trillion, and semiconductors now make up nearly a fifth of the S&P 500's value. There's a lot to unpack, so let's get into it. As we near the end of earnings season, earnings growth for S&P 500 firms is tracking at 25.5% year over year, well ahead of the 15% analysts were expecting for the quarter at the start of the season. With 8 of the 11 sectors growing double digits, this is a broad-based growth cycle, not just a couple of mega-cap firms carrying the index. That said, earnings were excellent for our core large-cap tech holdings, Apple, Microsoft, Alphabet, and Amazon, which all last week reported strong quarters. We're exiting earnings season constructive in their outlook. Earnings strength is flowing through to forward estimates. Expected earnings per share for the S&P 500 in 2026 are now at $336, up roughly 22% from 2025. And the 2027 number sits at $383, another 14% higher. Analysts have revised both these estimates up 8% year to date. That may not sound dramatic, but it goes against the historical pattern. Analysts typically start the year optimistic and then trim their estimates as reality lands. As for valuations, rising earnings have brought the forward earnings multiple down from 23 at the start of the year to 20, a level at which we think risks are more balanced for increasing long-term equity allocations. The key question for investors is how sustainable is recent growth and what's driving it. One of the main growth drivers remains AI infrastructure spending, which we still think is sustainable. Capital spending across the 6 major U.S. hyperscalers grew from $248 billion in 2024 to $422 billion in 2025. The companies are now guiding for $765 billion in spending this year, with expectations approaching $1 trillion by 2028. To put that in context, this is one of the largest industrial buildouts in U.S. history. In a single year, these companies plan to spend more than what the entire interstate highway system cost to build over 4 decades, adjusted for today's dollars. The market is comfortable with this investment cycle for now because revenue is following the spend. Sales at the major cloud providers continue to grow at strong double-digit rates, and AI companies like Anthropic and OpenAI are scaling at unprecedented speed. We'll remain vigilant in tracking whether the sales growth keeps pace, but the early evidence supports the infrastructure build-out. The spending cycle is reshaping the index itself. Semiconductor and semi-equipment companies now comprise 17.4% of the S&P 500, the largest industry weight in the index and the highest concentration semis have ever reached, up from just 2% a decade ago. The reason is straightforward. Supply cannot keep up with demand across the entire chip stack. Memory is the tightest segment of the market right now, with concerns building that CPUs could face a similar crunch. The supply-demand dynamic is allowing these companies to operate with unprecedented pricing power, and that's flowing directly to earnings and market cap. To be clear, we do expect a supply response. The largest chip manufacturers all plan to expand capacity, but new fabrication plants take 3 to 5 years to come online. So for now, the imbalance is likely to persist with pricing power showing up in earnings, margins, and cash flows. While all the companies in the AI value chain are profiting right now, the semi-suppliers are capturing a disproportionate share. Since ChatGPT launched in 2022, NVIDIA and Micron, for instance, have seen quarterly net income rise almost 20-fold. Their cloud provider customers are growing also, but at a more modest pace. The question is, can the chip and memory suppliers keep capturing an outsized share of AI's profits while their customers spend record amounts in building it out? Historically, semi-profits have grown in line with their customers. The current profit share is likely to further motivate internal chip efforts inside the hyperscalers, such as Google's TPUs and Amazon's Trainium chips. For now, the market is growing fast enough that everyone can win, even if the larger incumbents lose some share. While we remain constructive on semis and valuations do look reasonable relative to growth, the longer-term risk is that competition eventually erodes pricing power and normalizes profit margins. It's certainly a dynamic time in the tech space. As always, please reach out with any questions. Thank you and have a great week.